All right, folks, this is our weekly REIA meeting, our Real Estate Investors Alliance meeting, sort of our virtual real estate investment club that we pulled together this year. I know we've been on a little bit of a break the last few weeks. My birthday was back in May, and then we had Memorial Day and quite a bit of things going on. But happy to be back with you guys here in June. And also, I've got an old friend joining us. Keith has actually been a part of this meeting before. He sat in before. But if you heard some of the banter and conversation going on off air before we hit record, Keith and I have known each other for, I guess, Keith, about 15 years or so. I think you're one
Yes.
of the first people I met when I got into real estate investment banking. And I thank you for your patience with me as I developed my skills and got better and all the evenings and afternoons and mornings that you jumped on the phone and was willing to answer questions and sort of not only be a friend, but you were also sort of a mentor and trained me quite a bit on what was going on within the capital market space. So I'm thankful for that. Hopefully, I'm doing you proud now.
You are. You are.
Yeah,
Thank you.
so thank you for putting that time in. But I guess just to start, Keith, we normally just let our guests talk a little bit about what you do day to day. I know you've got a long time history in capital markets. You've been around over 20 years. So you've seen a lot of changes. You've seen a lot of these what we call once in a lifetime events that have
Yeah,
happened, over the past 20 years. But then once you get done, man, I've got a few questions that I'll ask
sure.
you. And
Sure.
then I'm certain with the group that we have here today, they'll have some questions for you as well. And then, of course, everything is being recorded and will be placed on YouTube later. So you guys can have access to that. Or if you really enjoy the conversation, hopefully you will share it with someone that would also enjoy the conversation as well. So thank y'all for being here. But go right ahead, Keith. It's all yours.
Okay. Well, hello, everyone. My name is Keith Morris. I'm in Atlanta and I'm with Lument. We are a lender that is a subsidiary of Orix Financial out of Tokyo. And I have been in the commercial lending space for 27 years now and lent on every asset type and but primarily been focused on multifamily for a good bit of my career. We are Lument is a direct lender for Fannie Mae, FHA, and Freddie Mac, as well as we have our own balance sheet from our parent company where we do bridge lending and some construction loans. We have had quite an interesting ride, I will say, the last few years where we've seen basically we had a period of free money and now we are what I would say we're in an interest rate environment that's very typical for when you look at it in a historical sense, but it's caused a lot of shock to the industry just because of the rapid rise. I mean, we probably are up 250 to 300 bips over where we were just, 3 or 4 years ago. It's caused quite a shock in the industry. And we haven't really seen prices come down because, frankly, demand for multifamily has stayed strong. Supply has not increased except in certain sectors, Class A, mid-rise, high-rise, they're going up, but nobody's building a standard garden style apartment complex, or not as many as they used to. So we still see very strong demand. Prices are holding pretty steady. And but I think it's still a good time to be a buyer out there for multifamily today. I still see assets trading for below replacement cost. I still see very strong demand out there, and I think it's expected to continue. We're seeing rent growth in certain submarkets start to come back, and it's actually held in certain submarkets as well. So, anyway, that's kind of a little bit about what I do. Typically, I am focused on getting out quotes and kind of helping my clients structure their financing. Perfect example, I'm looking at a deal right now in Statham, Georgia. Client is looking to buy it for $9 million. And I think we're going to be able to offer them about 72 to 73% leverage on that deal. And his rate will be in the 5.5 range, 5.5 to 5.75.
Hey, Key, can you expound on that a little bit more? How'd you get is that agency execution? Is that how you're getting the rate so tight?
That
Or
would be a Fannie Mae execution. It would be a 5-year term. You know, the 5-year is down about 40 bips below the 10-year. And yeah, um, 2 years interest only, 4.5 years yield maintenance on that deal. And yeah, I'd say, and it appears that from the financials I've looked at, that's trading a little bit over a 6% cap rate. So now, granted, that's
good.
kind of it's in a part of Georgia. It's a little bit on the fringe of Atlanta, but it is still technically the Atlanta MSA, so it gets pretty good pricing from Fannie or Freddie. It helps
Now
that
that's a
the
great
buildings, yeah,
that's a great rate in today's market right now. So yeah,
yeah.
that you're doing pretty good. I hope you win that one. Couple questions, I guess, for you, Keith. So the group that we have today is sort of a mix of folks that have done some real estate investing and folks that are learning to do more investing. Um, a lot of times people, when they think about financing, they think about conventional financing. So the bank or the credit union that's on the corner of Main and Main. Obviously, you operate more within the institutional capital markets. Can you talk a little bit about the difference and help people to understand the nuances between a balance sheet lender versus securitized lender?
I would say one of the primary differences is just that all of the lending that I do is non-recourse, meaning you are not signing a personal guarantee on the loan. If you go into your bank, 9 times out of 10, especially here in the Southeast, you're going to be signing a personal guarantee for that loan. And most investors, when they reach a certain size, do not want to take any more liability than the amount of money that they are putting into a transaction. So, and I've seen this happen where when the market shifts, if the lender has to take back the property because of market conditions, there's no risk to you beyond what the equity you invested in that transaction. A bank will take a very different approach. And then, that's a bigger issue when you're trying to scale up because if all of the loans on your portfolio are recourse, then any new lender that's looking to provide financing to you is going to see that as a significant liability. When you move it to non-recourse lending, then that's your only risk is obviously what you put into the deal. And so, as well as one of the big differences that borrowers will see is the way that we underwrite and structure a deal. It's much more asset focused. A bank is going to be looking at your personal financial statement, kind of scrutinizing that much more heavily than we will. I'm not saying we're not going to be looking at it. We're definitely going to go through it, but we're much more focused on what cash flow can we get comfortable with to underwrite on that deal. So we're going to be much more collateral focused. And sometimes it's a little frustrating for clients just if they're unfamiliar with it. But that's my job where I step in and I explain, hey, I try to be as transparent as possible. Here's exactly how we are getting to your loan amount. This is why your interest rate is X. And so it's all of our products, or most of the products that I offer are ended up, they're going to be converted into a mortgage-backed security, which will be sold on the open market. So it's a very market-driven rate. Not that banks aren't, but it's just, it does move and fluctuate a lot differently. The cost of, excuse me, the cost of funds is very different. So you can see periods of time where securitized lenders and bank lenders are very close to one another, and then times where they diverge significantly,
Yeah.
solely because of cost of funds.
Yeah, you said you've been in the business 27 years. That's a long time. So you've seen a lot.
Yeah.
Talk a little bit about just the evolution that you've seen within capital markets and capital in general. Like, for example, I know at the outset, the little conversation you and I had about small balance CMBS, that product has sort of went away. But talk a little bit about some of that evolution or even other evolutions within the space that we might be unaware of.
Well, so yeah, I will say securitized lending is obviously grew significantly through the late 90s and early 2000s. And then with the great financial crisis, that obviously threw a wrinkle in all kinds of lending out there. Um, but I would say the evolution that is most interesting to me sometimes is the evolution of investment styles. When I first started in this business, people held assets for much longer periods of time. I would say 10 years was kind of a standard hold period. We've seen that shrunk dramatically, especially when it comes to apartments, multifamily. And I think a lot of that was exacerbated during the pandemic when we saw rapid rent growth increases. People were able to flip assets, in 2 to 3 years' time. And I see that as kind of a blip. If you started in multifamily investing 10 years ago, you were probably in the best period of best period of time for returns that you're going to see for a long time. Just because of we just had an expanding economy and heightened demand, decreasing supply, just all those factors came together where it was really hard to do any wrong, you know, 5 to 6 years ago. That's not the case anymore. As we're as we're seeing a number of investors have issues with their assets because of the debt that they placed on it. It's you have to be much more careful in the space today, which is why investors are much more cautious. And I mean, we are a number of the acquisitions I'm seeing right now are being sold for less than the seller's cost basis.
Hmm.
And I will say I attribute that solely to them having a much shorter investment hold period. When you're looking at, hey, what can I do if I'm going to flip this in 3 years? Your mindset is very different than if I'm going to hold it for 10 years. And so that's caused a lot of heartache for a lot of people because they were not expecting to be in that investment for the time period that they're in. They were not expecting the need to put in more capital into the deal. And I will say where we were 5 years ago, everything was, pointing upwards. But if you've been in this space for a while, it can change very quickly. And, we all wear the rose colored glasses until, we have to take them off. And then all of a sudden we're like, what were we thinking? So yeah, it's,
Can you go back to something you just said a moment ago? I think you and I had talked on the phone about a month ago, and you mentioned this to me, and I just want you to shed more light on it. So you said that certain assets are being traded right now for less than what that investor's cost basis is. So they bought it a few years ago. Now they're having to trade out at it. They're actually trading out at a loss,
yes.
which that goes against conventional wisdom because people say you can't lose money in real estate. But I tell them stick around long enough and you'll see. Talk more about that because I think that's an interesting trend.
Well, you know, we're right about that period. I would say you probably saw prices most inflated in that 2020 to 2022 range. And there was a number of assets acquired with short-term financing, 3-year loans, maybe you got a 1 or 2 year extension. A lot of them were expected to be acquisition rehab deals, and a lot of them were on floating rate debt. And, there was a time period I was doing a ton of adjustable loans where at that time we were doing LIBOR, which was less than 1%. Whereas, now we've got SOFR, 400 basis points higher than that. So, a lot of those borrowers were not expecting to they were expecting the rent growth to continue as it had been, which, at one point we saw, I think, across the board, a 20% increase in rents. Now they've got, in a lot of submarkets over the last year, they've gone into negative rent growth. We're starting to see that turn now, but primarily they just were overly aggressive in what they were paying for the assets, put it on very short-term financing that was volatile if the market shifted, and then they didn't have the capital to stay in the deal long term when when the market shifted. And now we are seeing some borrowers come in and say, all right, I need to raise $3 million worth of equity and pay down my bridge loan and get this on something a little less volatile, put it on some fixed rate debt for maybe a longer term. But unfortunately, some of them are just taking the loss. And, that doesn't mean they're losing all of their equity. They're able to pay off their lender so that they can still, stay in the game and return some equity to their clients. But it's deal by deal. In fact, I was talking to a client the other day who was struggling with an investment, and he actually had to say, well, you know what? The way it turned out, I was able to give my clients a 10% IRR. And that's certainly not,
That's
something
horrible.
that, no, but from his perspective, knowing the deal and how it worked out, he was happy with the 10% IRR because at certain stages in that investment, it looked to be negative 10% IRR. And so for him, he knew that that's not something he wants to. It doesn't look great from a lot of vantage points, but from his vantage point, the fact that he was actually able to turn it from a negative to a slight positive, and the time frame in which he held that asset and the specific things that happened to him, he considered it a win. And yeah, I mean, certainly nobody's going to be bragging 10 years from now about a 10% IRR. But if you're able to say that, hey, I was able to return my equity to my clients and give them a little bit for their money, that's I can understand from his perspective why that was a positive. But
You
it's just, yeah.
count the wins wherever you can. But I just got a few more questions for you. I'm gonna turn it over
Sure.
to the group, let them jump in. With some of the things you're talking about right now, the trends that you're seeing in the multifamily space, I heard you at the outset say that, the multifamily asset class still seems to be the most popular of all the asset classes, and I agree with that. Are you seeing specific trends within the asset class? Is it mostly acquisitions? Is it value add? Is it construction? Is it all of the above? Or
I would say that, well, the trends that I'm seeing right now are obviously we still have refinances, people with, loan maturities and whatnot. But the acquisitions that we are seeing, again, they're more opportunistic. I've talked to a couple of developers who build kind of core assets, class A core product, things that would be sold to life insurance company, or some, equity fund to be held for a long time. And none of them are coming to market this year. All of them have told me that they're delaying sales of those assets until 26. And the reason being is that they feel like the sales market right now is much more focused on these deals where where borrowers are in trouble and they need to unload the asset. And it's not going to be maybe at a complete loss, but it's at less money than they were hoping for. So I hate to use this term, but there's a lot more vultures circling the water or the fields these days. And so I'd say that's primarily what we're seeing. And I hate to put it that way because we are seeing also new product being sold for what I would consider, a very justifiable cap rate. I mean, the asset I mentioned earlier, that is a one that was repositioned. The seller bought it, renovated it, listing it for market right now. It's right above a six cap and you know, I'd say that thing is priced where it should be. But this asset would have probably traded for a five cap 3 years ago.
Yeah.
So that's actually a good point to make, which is I am seeing cap rates come up slightly. There was a time period 5 years ago where it seemed like every property that traded was a five or below cap rate. And it didn't matter if you were in, Atlanta, Georgia, or Athens, Georgia, or Macon, Georgia. They all seemed, there was such a frenzy for product out there. It really compressed cap rates to a very tight range. Whereas now we're seeing that market spread out and people are saying, no, the risk profile for this asset demands a higher cap rate, and that's how it was always been. So it was just when we saw that kind of feeding frenzy, right around the pandemic, we lost a little bit of our senses there, and
Well, I think the shift in the rates too had a lot to do with it.
it
I
did.
mean, when the rates were so low, I mean, you could come in and buy something at a 5.5 cap, and you're putting a 4% or 4.5% loan on it, and you still can make money. But I think when rates started moving the way they did, it had to eventually push cap rates up, or you'd be inverted, in terms of your return on asset and then your cost of capital. But
You're exactly
um,
right. And I mean, we were in a once in a lifetime environment where essentially we had free money. And, you know, to anybody asking me, when are we going to see rates down in the threes again? Probably never. And if we
And we shouldn't.
do,
We don't need to. It
if
like
we if
it's
we
not
see
even
that
healthy.
again, it's
Yeah.
probably not a good thing. It's another
Yeah.
thing like a global pandemic or, you
Yeah.
know, civil unrest or war. I mean, it's not, that wasn't a good thing. So that's why rates were at that level. And so yeah, I don't think we'll see that. Hopefully not again. Because frankly, even right now, 5.5 to 6.5,
It's a good
that
rate.
is, when you look back over the last 30 years, those are good rates. I mean, when I started in the business, we were in the, high sixes, low mid sevens, sometimes in the eights. So it's, I think,
Yeah.
yeah,
When I met you, we were pricing deals at 8%, and people would get ecstatic. They'd be happy. That you'd be bringing them down from a 9 to a 8, and then they'd
right.
be thankful. But yeah, I think rates in the 3 to 4% range is not good. I mean, anytime the Federal Reserve is cutting rates like that, they're doing so because they're trying to stimulate growth. So that it's not a good thing when it's happening. So I do think rates are probably in a range where they make more sense for the macro economy. But here's one last question. You and I
Sure.
met 15, 20 years ago. We met before social media was popular. LinkedIn wasn't really popular. I mean, hell, the internet, I don't think was, everybody didn't even have websites still. I think when you and I started interacting.
Right.
And my question is the way we found capital partners like you used to be a lot more guerrilla. Like if you weren't at the conferences or if you weren't in certain physical environments, you never got to know a Keith Morris.
Right.
I couldn't just Google. I guess I could have Googled Centerline Capital, but their website would have been damn near non-existent. Wouldn't
Right.
even
Right.
known it. Talk a little bit about that. I mean, it seems like now some of the alternative capital partners like you fall in that alternative space. It seems like it's a lot more prevalent right now. Talk a little bit about that change and how newer investors and developers that are coming into the space can connect with capital partners beyond just the bank and the credit union?
So you're absolutely right. The way that you connect with capital partners is very different today than it was 15, 20 years ago. It used to be that you would have to go out and do it the old-fashioned way, and get out there, shake hands, meet people, have those, in-person conversations. Of course, you were able to connect through, even 15 years ago, the internet was definitely very relevant in, sourcing business and finding capital partners. But it's changed a lot because we've also seen an influx of private capital lending on commercial real estate that we haven't seen as you didn't see that as much 15 years ago. You see a lot of bridge lenders, smaller firms that are just raising capital from private sources, putting money out there. And it's interesting because I will say some of those capital sources tend to be very popular for a short period of time. I can think of a number of lenders I've seen over the last 5 years that were very hot and very aggressive in their lending, and then have had to pull back dramatically because they overshot what was feasible. And why I think that's an interest to your audience here, it used to be the mindset, if the bank or this lender is going to give me this amount of money, then that is a very reasonable and appropriate amount of debt. Over the last 5 years, I've seen lenders be too aggressive, putting too much debt on an asset, and a lot of investors were thinking, well, if they lent me the money, then that was the right amount of money or the right amount of debt to have on this asset. And now, if they're having to sell the property for below their cost basis, clearly that was not. So we've seen a lot of over leveraged deals result from this influx of a massive amount of private capital putting money out there on commercial real estate. So I guess in closing, I'd just say, just because somebody's willing to give you that amount of money for that amount of debt doesn't always make it the right amount of debt to have on your asset.
That's very good. You guys, if y'all have any questions, we certainly have quite a bit of time left. So,
Hey Keith, appreciate your time with us. My name's Trajan. I'm an architect, Winston-Salem, working with Walter Robbs, Michael Graves, and I'm interested in the real estate space. And I'm curious, you mentioned that kind of the investor community is in shock right now because of the interest rates going up so rapidly.
Yes.
Historically, it's not out of the norm. So I'm curious, like out of the deals that are penciling out, what is it that is allowing them to pencil out? Because I don't think it's necessarily because we're not historically out of the norm. I'm just trying to figure out like how do investors come out of that shock and what types of projects are successful in this environment, if this is something that's not out of the norm, not out of the norm.
Sure, sure. Very nice to meet you, by the way, Traydon. And all right, so I'll use an example of just two deals I'm looking at right now. One of the big things that makes it work today, one, the asset needs to be well maintained. Most of what I'm seeing has either been built in the last 5 years or renovated in the last 5 years. So it's also in a submarket that is seeing maybe minimal rent growth, but some rent growth. So at least you see the perspective or the you still expect your cash flow to grow from rent moving forward. The biggest thing is you have to put in more equity. Most of the acquisitions I see right now, you're seeing LTVs anywhere from 65 to low 70s. The deal I mentioned earlier, 72% LTV, that's what I would consider a great deal. meaning I'm able to lend that much on it. Most of them are more in the 65 to 70% range. So investors need to be comfortable putting that amount of equity into a deal, and they also need to be comfortable maybe staying in the deal longer than they had expected. They might have thought, oh, we're only going to need to be in it for 3 years. No, you need to prepare for 5 to 7 years. And so I would say more equity going into a deal, and a strong or at least a very stable submarket, and in a location that hasn't been oversupplied. I mean, I will say that's another factor. We've seen in certain submarkets just too much product being added, because it was the one place you could build. It's so hard to get any new construction up these days. Anytime there's a specific area that, I'll use an example. I did a deal back in 2020 outside of Charleston, Monk's Corner, and there's a auto plant out there that exacerbated the growth out there. And when I was out there, I mean, we saw, you know, new builds going up all over the place. And it was primarily build to rent, so like townhome style, but for rent communities. But we saw them everywhere. Now, most of them seem to have for sale or sold signs on them, but unfortunately, so much of it came in that at one time that we ended up we did make a loan to the client there, but the investment did not perform as expected. They were still able to make a return on that, but there was just so much supply coming in, they just could not maintain any rent growth. And in fact, just really struggled keeping occupancy stable on that deal. And partially it's because they had their expected investment hold period was only about 3 years. Now, had they anticipated maybe a 10-year hold, I'm sure they would have done much better. So I'd say patient capital. It takes a while to make your money in real estate. It doesn't happen overnight, but it did happen overnight, and that's why we're in the situation we're in.
All right.
Does
And I'm
that does
curious,
that help?
it does. For new construction, have you seen projects that have, is that something that people are struggling with due to price volatility? And I know that's an additional pain. What are your thoughts on new construction right now?
I think if you can find a location where it works,
Mhm.
build. But in a lot of cases, it doesn't, because of one of the things I said earlier, where if you can still buy a project for below replacement cost,
Right.
well, you're going to do that. So unless I was talking to a developer the other week, and he's only starting one project this year, whereas normally he would do 4 to 5 projects a year.
Mhm.
And it's because he only found one site where it made economic sense. Happened to be up in Asheville, in kind of a hard to build location. That was the only thing that's penciled out for him. But a lot of it is because he knows that if he had to sell that asset today, it would be for less than what he put into the project.
All right. Thank you. And
Yeah.
my final question, are you all leveraging any of the emerging technologies in your practices as lenders in terms of, making your processes more efficient or thinking along those
I'd
lines?
like to think so. I mean, I will say, I have seen, I'm old enough, unfortunately, to remember the days when we actually had to sign things in person and send paper through the mail. Whereas, these days you can electronically sign everything, you can submit everything for a loan on the internet. I mean, we have a portal where borrowers just upload everything directly. We have offices in India that can do processing overnight. So, I mean, I feel like we definitely take advantage of the existing technologies. The emerging technologies, AI, I know that's going to come into our space and probably already is. but I won't say that I'm smart enough to know how it's going to affect us. I mean, one of the biggest things I will say that we're seeing is using AI to help detect fraud. There's been some high profile lending fraud and a lot of tenant fraud that has impacted the industry. It's very easy for somebody to create all the documentation that it takes to rent an apartment. And, you know, if you're not able to figure that out, you're going to get stuck with about 5 or 6 months of lost rent there, as well as eviction costs. So, again, I was talking to another client, had a property down in Stockbridge where the property management firm was not up to date on how to detect some of these fraudulent documentation. And they were stuck with at about 75 to 80% effective occupancy because they had so many bad tenants in there. And yeah, and on the lending side, we do significantly much more verification of assets to make sure that things are as clients say they are. Because again, there's been some really big losses stemming from some of the fraudulent mortgages made. So
Yeah,
I
Keith,
think
I
AI is
think
going to continue to be a factor in detecting that.
I think some of the AI technology I'm seeing coming into the property management side is really, really cool and important. I mean, to prevent exactly what you just talked about. Now, in the residential lending space, AI has made a huge penetration. And I mean, you talk to some of the larger banks, and now quite a bit of the loan underwriting for a residential mortgage is done through artificial intelligence. And then there's some human underwriter or credit officer that looks back over and signs off on it. But I think, from my experience, I think residential lending is so standardized that that's a great use of AI because pretty much there is really a box. And
Right.
does the property fit in the box, or if you're going to get a car loan, that there's a real well established box for that. I think, and maybe I've been around too long, but I just feel like within commercial, it's going to be a bit more difficult to do that because there's all these nuances when you're looking at an apartment complex versus looking at a hotel or looking at an industrial property. It just feels like to me there's still going to be a need for someone like you or someone like me or humans to be involved that are actually looking at some of this. Now, obviously AI may get so smart at some point, maybe you and I don't have a need for a job and we're partnering together and
Oh, I
opening
would
an
never say
investment
that.
firm or something. I don't know, but
I
but
still
yeah,
feel
it feels that way.
I think
But
you'll
it
always need the human involvement. I mean, I don't look at AI as replacing as much as enhancing.
yeah,
I mean, a perfect example is 20 years ago, if you wanted to look at a property, you had to get into a car and you had to drive to that property.
yep.
Whereas today, I can go on Google Earth and I can do a entire tour of the neighborhood sitting here in my home office.
You might even be able to go inside the property. I mean, depending
Yeah.
on
So,
yeah,
I
I mean,
mean, think
depending on what they have
about how,
available.
AI is going to package things up for us to review much faster than what we're accustomed to now, but it will absolutely still need a human element in it because it's just too complex as well as, I mean, real estate is a human asset. It's, you know, why we value something is very much the human experience. You know, why is that space you're in $20 a foot versus $10 a foot? A lot of it isn't always the finishes. It's more about what the human determines its value to be. So,
Based on location and perception and all these
and
things.
what we
Uh,
want. Yeah.
But I will say, when I'm doing like nowadays, if I have to do an underwriting summary or if I have to do an illustration for an investor to show them how $100,000 is going to perform or whatever, yeah, I use Chat GPT for that. I feed in my inputs. It'll assimilate and bring it all together and give me a nice little summary that I can shoot to you or shoot to
Right.
anyone else. Now, back in the day when we used to do this, I'd be sitting up for 3 hours, trying to figure out how to put my underwriting summary together and explain the deal to you. So
Right.
I do think those enhancements are there. I also want to chime in on something Trey talked about when he said, what does it take now for deals to really work? And I thought your response around more equity was spot on. And I think part of the issue that's occurring, if you came into this industry and this business like when we did 20 plus years ago, it used to be these transactions all got funded with more equity. I mean, you didn't have people coming to you all the time saying, "Can I get 80, 85% loan to value?" I
Right.
mean, you had more conservative investors and developers who wanted to be in that 65 to 75% range. Feels like to me what happened in the last 10 years is some of the newer investors and developers that have gotten into our industry, they've gotten addicted to the higher leverage. And now with the higher interest rates, the higher leverage deals don't pencil out any longer. And so that group or that subsection of investors is saying the market is broken. Well, the market's not broken. You just haven't been in the market long enough.
Well, and it's
But
just
yeah,
part of the cycle. I mean, before the great financial crisis, that's what we saw. We saw leverages go up. I mean, I remember back in 2006, lenders underwriting based on future rent.
yes,
I mean, it was crazy now that I say it out loud, but they would say,
yes.
okay, well, the rent's $2,000, but we're going to underwrite 2,200 because that's where it should be.
I used
Um,
to put forward commitments in place for deal. Remember you could get a forward commitment back then based on
yes,
future rents. I mean, I used to do all that kind of crazy stuff, but it's now we've just gotten back to normal, normal
yes.
interest rates, normal leverage, normal underwriting. And I think that return to normal is what's causing people to get so frenzied.
I would agree with you. And, I think we're going back to fundamentals a lot, investment fundamentals a lot. And which I would just add one other thing that makes a investment a good investment, Trey, is somebody who's focused on the operations of the property. For far too long, investors were just buying assets, throwing in a third party manager, and not drilling down as to how to most effectively and efficiently operate that property. Whereas you need to be very much boots on the ground. Why is my water bill this high? Do I need to shop my insurance? You always need to shop your insurance. What capital investments can we make to decrease our operating expenses going forward? Things of that nature.
Got any other questions out there, Terry? I see you're with us today. I hadn't seen you in several weeks, so it's good to reconnect. And then we do have a new guy with us, Felix. Felix actually came to a little live in-person luncheon that Trajan, myself, and several others had out at Foothills some weeks ago. I know Felix is a newer investor out in the Burlington area. But Felix, I know you don't normally join us on Friday. You want to do a quick introduction or you even have a question for Keith or?
Yeah, thank you very much, Algenon. I've been following. Sorry I joined late. I almost missed this, but the last part that I caught is very, very important, and I agree with everything Kate was saying. To introduce myself, I'm an investor here. I live in Burlington. Um, Currently, my properties are single family homes, but I'm pushing into the commercial space to do more multi-family homes. But my buildings are in Cary, Morrisville, Durham, Raleigh, and then Burlington area. So I live in Burlington, so I want to do also more deals in the Triad as well as the Triangle. And I also do have few properties in Fayetteville as well. So my goal is to moving forward do more commercial deals, not just single family. So we are taking the company into the commercial space. So it's good to meet Algernon so I can learn more from him and also um, learn more about the commercial space as well, both on the lending side and also on the real estate side as well. So nice meeting all of you.
Thank you for being here, man. I appreciate you. I had a great time with y'all a few weeks ago. That was Really, really fun luncheon. Trey, you missed it, man. You left a little early, man. We were there probably 3 hours. I'm not exaggerating. I think we
Y'all
stayed there 3 hours
stayed.
talking. Yeah,
Yeah.
yeah.
Wow.
It was a lot of fun. I
Mm.
was really the highlight of my week. But go ahead, Terry. I saw you come off mute. You go right ahead.
Yeah, I was gonna uh mention something I guess it's been going on in my mind some and trying to investigate since some of these penciled in stuff with single families are not working so great, but there's I don't know if it's really new or not, but maybe the co-ed type living styles in single families where you get much higher rents for single bedroom, but it's shared amongst others. What type, have you worked any of the lending stuff in that type of atmosphere with that?
You talking to me or Keith, Terry?
Keith, I guess Keith.
Okay.
Yeah. Yeah.
Well, Keith, do you even? I mean, I think
Yeah.
everything you do is multifamily. Do you do any single family?
Well, we don't do any single family, but we have looked at single family for rent as a block.
Like a
I looked at
portfolio, yeah.
well, but where it's a subdivision that or a neighborhood that was built exclusively for rent product. They want to see Fannie and Freddie will take a look at it, but they want to see that it's what's considered a unified project. So if you're pulling in and it's the Pines at wherever, every single family home there is for rent. It was built as a for rent community. They don't want to be mixed in with for sale product. So that is something you can get a commercial loan on. And in terms of Terry's question about co-living, we were looking at some co-living projects pre-pandemic. I looked at a deal in Los Angeles. It was actually near Hollywood, and which is obviously very expensive area. And so this developer was looking to develop a co-living project where you would, again, it's almost like student housing is today. Unfortunately, the pandemic kind of blew up a lot of co-living projects because people couldn't live together at that point, and you certainly didn't want to live with strangers. So I do expect that, excuse me, that to kind of come back in fashion. But it tends to be much more higher rent areas where somebody's willing to deal with, the frustration of just having one bedroom and bathroom. The cost makes it worthwhile for them. I don't know
So
if it's
so Fannie and Freddie will do them if they're contiguous, but if they're scattered, they won't.
yes, for
They
single
won't do
family,
them.
no.
I got you.
Well,
And
the
then
reason I bring it up too is because, which some of the reasons why I've been absent in some of these things is because I've been dealing with my mom and getting her moved over into an independent living
Mm.
location, which, as the investor that you always are, that renting out these, little rooms in a old hotel type situation, it makes for lots of rent coming in and high rents. So I mean, what about that in the commercial side where you take an old hotel and changing it over into an independent living location?
Actually, I've looked at a couple of hotels, motels that have been converted to multifamily. I would think an independent living facility would work fine with that. I actually years ago was an investor in a former hotel that had been converted to multifamily. So I think, you know, not to digress here, but when, people were talking about the housing shortages, a lot of people are like, we need to convert office buildings to multifamily. But that's very difficult. But converting hotels or motels to multifamily, much easier and much more viable. As housing costs increase, people will pay more or will accept a smaller living space if it's what they can afford. I mean, so one of the challenges obviously in converting hotels to multifamily is, it might only be anywhere from 300 to 600 square feet. But for your situation, an independent living facility for senior citizens, I mean, they don't need 1,000 square feet. So, and in fact, they might benefit from the communal spaces that a hotel might have built into it, because they don't want to just sit in their room alone all day. They want to come down to the, and visit with their friends and bingo, whatever it might be that they want to, spend their time on.
Yeah, Keith, to your point, and I'm gonna wrap us up, guys. I talked to an Indian group yesterday, and that's actually what they're working on is hotel conversions to multifamily. And I know here in downtown Winston, we've had a couple of projects that have happened that way where hotel units got converted to apartment units. And I think that developer did some cool things with like taking certain hotel units and combining them so you had more square footage and that kind of thing. But to your point, it is a little easier because a lot of the plumbing is already ran for all the separate bathrooms and all those kind of things. Whereas with office, you may not have all that infrastructure built out, so you end up spending more money. And then Terry, the whole co-living thing is really a new play on an old idea. I mean, those are basically just boarding houses. Is what they are. People just come up with a new name for them. I mean, but
Yes, that's true.
but what they are is it's just a boarding house. My point of saying that is you probably would want to look into some of the zoning around that. A lot of municipalities do have some strict zoning around where you can put a boarding house, how many rooms for rent you can have, just some of those kind of things. I know Winston-Salem, Forsyth County specifically, does have some strict guidelines around that. So just take a look at that when you decide to do it. Keith, this is a great conversation, man. I think we all enjoy talking about money. It's the most important part of any real estate deal. I mean, I say all the time, you can have the greatest deal and the best location, but if you don't have capital, either your own money or outside capital to do it, then you're probably going to get stuck pretty bad. So I appreciate you doing this, and I'm certain there was some nice jewels and nuggets that you shared today to help people learn more about what you do and what's happening within the capital markets. Of course, this conversation will be available on my YouTube channel later. You can go back and take a look, listen to it. And then if you actually want to reach out to Keith directly, if you got a project you want to talk about, I know Terry has talked to Keith one-on-one before, but I'm happy to share his contact information, and I know he'll make himself available to chat with you. Before you go, man, I see those plants and things in the background. So do you got some kind of a green thumb when you're not lending all these millions of dollars, or?
Yes, I am a gardener and I do enjoy my plants. It's a welcome diversion from the stresses of this job. In fact, it's sometimes nice just to get outside in the middle of the day after I've been on the phone or staring at the computer for so long. I just being outside and just kind of enjoying some of nature is always something to help relieve a bit of that stress. So,
Oh, that's cool. I saw your cat make a cameo appearance a
oh,
couple
I'm
times.
sure he
So
did. Sorry about that. He's kind of my coworker when I work. I'm in the office 3 days a week, but I get to enjoy Monday and Friday from home. And yeah, he's not a very active coworker, but he does show up every day.
no, that's good, man. Again, thank you so much for your time. We'll definitely get you back again. We'll
Okay,
keep an eye on the
happy to
market,
do
and
it.
yeah, happy to bring you back in. As always, to the group too, I always like to offer this to you guys. If there's a certain subject, topic, speaker, something you want to hear that I haven't necessarily curated, please drop me a note. I'll try my best to get somebody in to talk about whatever the topic is you give me. We will be off in July, so we got a few more meetings this month for June. I think I've got Lou Baldwin coming in. Trey, I think Phil Talkman's going to come in at some point here and chat with us as well. But then we'll be off for the month of July. We'll come back in August. Couple of news items. I think I mentioned this a few weeks ago. If you are a real estate wholesaler, you should be watching very close attention to the North Carolina General Assembly. Um, if the bill that they are floating through the General Assembly goes through, you will not be able to wholesale real estate any longer in North Carolina without a real estate license. So that's something that we're keeping an eye on. I do feel pretty strongly that the bill is going to go through. The North Carolina Realtors, and they're the ones that's really pushing it. So they're the ones behind it. They are the biggest lobbying organization in North Carolina, probably outside of the home builders. So it does feel that the bill is going to go through. I've got a conversation with Robbie Perkins on my radio show on Monday, and I think he's going to talk a little bit more about this and give me an update on what's going on.
They have
Then,
a date yet?
huh?
If it does pass, what would the anticipated enforcement?
I don't have any clarity on when implementation would happen. It looks like the current legislative loan session should end in July or August. They're pretty close on getting the budget reconciled. Then that's when you'll see a big flurry of bills come through. This bill is supposed to be one of them. But it may be, Trey, that it might even be that it has to pass first and then get sent off to the ruling organization. Then they might come back and then say, hey, this is when implementation may occur. But if I hear anything or if it shows up in the paper, certainly I'll try to notify the group.
I've
But
been
but
sending
I
my
do think it's going to
complaints.
pass. I think the legislation is definitely going to move through. One last news item too. I don't know if you caught this or not, but this is big news. Aircraft company manufacturer is coming to Greensboro, Guilford County. That got announced yesterday afternoon. They are going to create 15,000 jobs in the Triad area, and you're talking about billions and billions and billions of economic development. This is actually the largest economic development announcements in the state of North Carolina in the history of North Carolina, and it's actually happening right here in the Triad area. So we're very excited about this. Robbie Perkins is actually coming on Monday to talk more about that project, and so I'll have that on my podcast at some point next week. But if you haven't taken any time to learn about it, I'd go online, go to the governor's website, read about what they're talking about. But this is going to be a lot of jobs and a lot of money coming into the Triad, specifically to North Carolina as a whole. That means more houses, more apartment complexes, more offices. I mean, it's going to be 15,000 jobs. I think Keith can speak to that. That's a big number.
This is the Jet Zero project.
It is, yeah. That's a big number for a state like North Carolina. So a lot of us are really excited about this, Keith, and think it's going to make a huge impact, not only in the Triad but across the state.
Absolutely. Those are good jobs too. I mean,
Yeah, median wage is $90,000 a year.
yeah.
So I mean that does a lot to uplift our housing market, retail market. In fact, the crazy thing is, I had an investor 30 minutes after the announcement. 30 minutes after the announcement, I had an investor call me and he says, "Man, I want to buy this office building that's available for auction." And he said, "Can you help me with it?" And I said, "I sure can." So that's the kind of quick reaction that you get when you hear an announcement like that, because obviously 15,000 jobs coming in the market, that is going to help our office sector quite a bit.
Absolutely.
So yeah, big news for the Triad and big news for North Carolina. Again, thank you guys. I think we're right at an hour, and if y'all need anything, give me a shout. Thank y'all. Have a good
Thank you
weekend.
everyone for your time. Appreciate it.